Good evening, afternoon, or morning, depending on where you're located. Welcome to episode 4 of our crash course here at V2 Trading. Today we will discuss retracements, and I'll make this video just like last episode. We'll make this short and sweet so you guys can take your time to practice and actually see these in real time because I know the market should be open when this is released, hopefully. So, today we'll be looking over fair value gaps and gaps as well in the market and the importance of these and how we use it here at V2 Trading. Additionally, we'll look over our V2 levels regarding the Fibonacci tool. I'll give you the setup for that as well. And especially we're going to look at chart examples a lot in this video so you guys really understand what I'm talking about. So let's dive straight into this. So let's talk about what fair value gaps are. Fair value gap is when there is a wick gap provided by 3 candles. I'll show you an example of this really soon. And a gap is created by the market when heavy imbalance occurs. These typically get filled immediately. The best way I can teach you this is by showing you an example on the charts. So let's look on the NQ charts on 5-minute time frame. Let's go to the present and let's see what happened on Friday. Let's just mark out however many fair value gaps as you can, whether these fair value gaps work or not. I already see one decent play that would have worked out. So you have a fair value gap right here. What is a fair value gap? Let's take a look. A fair value gap is when we have 3 candles, right? 1, 2, 3. 1, 2, 3. Where do you see a gap between these 3 candles? In the wicks, right? The wicks are there, but the wicks don't connect between these 3 candles. Typically when there's no fair value gap, it will look something like this. You see how this wick is there and this wick is there? There's no gap there. But when this wick is there and this wick is here, look what it leaves. It leaves a pretty big gap right here. And this gap typically leaves an area for fair value, which means it's a good area where buyers are looking to get in. And that's typically what happens. There are 2 examples which show up that truly demonstrate this. Let's take a look. In this first example at 9 a.m., we saw this big downward expansion. This was high impact news additionally. We saw a move up, came into this fair value gap, and from this fair value gap, we saw a wick right above it filling the entire fair value gap and saw continuation downwards. Fair value gaps typically stand as continuation signals, but when they're broken with confluence, this is what you call an inverse fair value gap. Let's take a look and see if you can find any of those here as well. Let's take a look. Okay, perfect. Right there. This is where a fair value gap was created. And this is where a fair value gap was broken. When the fair value gap was broken, it showed clear indication that price wants to go higher. And if you have a upwards bias from here itself, this can be a great indication of an entry, and you can enter somewhere there and take your target wherever you want. Additionally, regarding the continuation signal, if you look right here, this is literally a perfect example. What did price do? Price went up and made pretty big expansion. And what did that do? It left a fair value gap right there. Then price retraced into this fair value gap where buyers think it's a good value to enter back in. And what happens? Buyers do enter in and move all the way back up. This continues the overall trend in the market. Now, I want you to take a look and really tell me if you've understood this. This is a fair value gap. Why is this a fair value gap? Because we left a gap between these wicks. Fair value gaps are used for trend continuation, or they're also used for entry models where the fair value gap is broken, indicating reversal. You can use fair value gaps in many of ways, and it depends on you as a trader regarding what works best for you and what you find the most success with, because what I may find success with, you may not. It's all a process of trial and error and finding what's most comfortable for you in terms of risk management and overall strategy. Let's take a look at some gaps as well here on the VIX. What happened? we created a big gap here, and these gaps are much more easy to identify because look, it's literally a gap in the market. Like, you can't go wrong with these, right? We created this big gap, and these gap fill areas tend to be areas with lots of liquidity in them, whether that be the top of it, which is up there, or the bottom of it. Typically, when you break the bottom of it with strong momentum, like something around there, we typically continue all the way down. So there's different entry models to be placed with that as well. Think of gaps similar to fair value gaps as well, but gaps typically tend to get filled fully when there's momentum as compared to fair value gaps. So please keep this in mind. Now let's take a look into V2 levels. The V2 levels is 3 key levels in an area of good value to provide confidence for an overall entry. And to show this best as well, you have to go into the Fibonacci tool and help you guys set this up for you guys to use if you wish as well. Let's dive straight into that. So let's just do this on the 1 hour time frame to make it much easier. Alright. No, actually, let's go 15 minutes. 15 minutes seems better. Alright. So, V2 levels is essentially just that. It's these key levels that are an area of good value that buyers may want to enter in. And as we've seen here, in the live market, it actually looks like the V2 levels are holding up pretty strongly, creating higher highs, higher lows, and also higher highs. But this truly shows confidence and gives you another extra area and extra tool for confidence in the market. My Fibonacci would look much different than other individuals' Fibonacci because of how I set it up. So you may copy my settings here now. Alright, so Fibonacci typically works when price reaches any one of these levels. We may see reversal to the upside, or it could act as an area of retracement. Additionally, when we break this 0.75 level, think of this similar to an inverse fair value gap, because when we break this, we typically continue to the downside or to the reverse side. So there's many ways to use this as well. Take a look at some other examples, starting right there. Would you look at that? Price went all the way up in this range, retraced back into this V2 level, pushed straight back up. You can find literally thousands of these examples every single time. Let's take a time where we see a V2B or where the V2 level has been broken. One good example would be right here, right? So what happens? Look how strong we break 0.75 out. We broke 0.75 with momentum. We may catch an entry somewhere there and carry out until these highs. What did it do? It did exactly that. So you can use these V2 levels just like fair value gaps in a multitude of different ways, and you should use this as another tool in your toolbox. Just like we showed, think of fair value gaps and V2 levels like purchasing. In real life, you want to purchase something when it's at a good value. When it's at a discount, you want to purchase it, right? When something is 50% off, you're going to be more inclined to buy something than when it's at full price. This is similar to the actual markets, and you should think of it in a simple way as well. The worst thing you can do is overcomplicate things. Think of this very simply and just keep working to make this simpler to you to understand. And that's it for this episode. This episode, what we did was we learned what fair value gaps were, we learned what V2 levels were, we learned what gaps were, and we learned how to use them and how to mark them. There are varieties of ways in which you can use fair value gaps, and V2 levels, and that's up for you as a trader to decide. I showed you a couple ways that I use them, and you may try to paper trade and actually practice them before the next episode tomorrow as well. I highly encourage you to give this a shot and try maybe even combining our supply zones combining our zones with what we've learned today, and also liquidity as well. This will really help you stand out as a trader and get into the topic of combination, which we will get into next episode tomorrow at the same time which this episode was premiered. Thank you so much for hearing episode 4 of the crash course, and I'll see you guys tomorrow. Thank you.